So I was thinking, as I was moving about the city, about last week's conversation, specifically the difference between what you were talking about, rent-seeking hedge fund managers, or whether you're like these fees for asset managers. We're talking about the hedge fund guys, and you're like, this is nonsense. You're a little offended. It was a little morally, you're like, these guys. And then you're like, on the other hand, you have people like, and you're like, I know Ken Griffin is no, he's not.
He's not an altar. He's not an altar.
He's not a Paddington bear that you would buy at Heathrow as a gift for your granddaughter.
He's no altar boy, as we like to say.
He's no Paddington bear. But at the very least, you argued his business has a value proposition, which is it creates a better priced, more liquid market. It contributes value to supply that service.
Sure.
Which I think is an argument, personally, I believe that has merit.
Yeah, I do too.
So that made me think, and and the reason it resonated with me is I spent the first just short of a decade, but call it a decade. It was maybe 8.5 years. But it was also my first years. It was 22 to 30 or something like this, working at Bloomberg, and working for Michael Bloomberg, who hired me as a person when it was a small company. And then I got to be in the first class of reporters. And when we blew up, it was crazy, 10 years. And so I was asked a lot, why is Bloomberg so successful? What did Bloomberg do? And I would say, ignore everything, snooze, this, messaging, data, TV, bullshit. Bloomberg figured out, the person, Michael, that there was not a good supply of buy-side information in real time from the bond market. All the information, all pricing information in the 70s and 60s at Solomon and Goldman was on the sell side. And if you ran the North Carolina or the Illinois pension fund and you wanted to buy muni bonds, you called Solomon Brothers and they told you a price. And there's no price visibility to the buy side beyond calling New York. And Bloomberg was really the first person, he was the first person to create a consumer product for the buy side that shared bond data. So that when the Solomon Brothers person quoted a bond price, there was all of a sudden a two-sided market with different information. And my summation of that was the wide spreads in the bond market Mike Bloomberg's wealth is a function of exploiting a data solution to a bond market wide enough you could drive a truck through it before he showed up with buy-side data, which is another version of saying he made the bond market more efficient, and so he took made money and created value by making it better better prices for teachers when they buy bonds in California, because now bond spreads are nothing, and everybody has all the same information.
Okay.
Which would be another version of Citadel, different time and place, right? I'm contributing a proposition. And I would say the third example I thought of, which I won't talk so long about, was decimalization, the transition 99, 2000, 2001, whatever it was, where we're about to create market efficiency and consumer access for the retail investor by getting rid of fractions. So an eighth is 12.5 cents, and we're going to make it a penny wide, maybe, or 50 cents, depends. But if it's Apple or if it's something hot, it's a penny wide or 2 pennies wide, worst case. And that creates value. At the same time, I was thinking about how corporations project the illusion of consumer value when the economic action is actually just a move. Instead of the spread being everywhere with all the exchange floors, for example, it's now all with Ken's Citadel or payment for whatever the service is. I don't mean to pick on people. Or maybe the bond spread didn't go from the bond spread to the teacher's pension, but from the bond spread to Mike Bloomberg and the data service fee and all the other things. And so I guess my question to you is, does payment for order flow really deliver value? Obviously, the answer is yes. Liquid, fast, bumping markets. Can't argue with it. So then the only question is the value proposition for payment for order flow, the delta of that efficiency capture, what percentage of that is being captured by a set of companies, Citadel //, and what percentage of that is actually moving to the consumer? Which would be the same question for Bloomberg. What percentage is coming to Mike Bloomberg and the data services writ large? And what percentage is going to the pension fund manager? And my concern is when you look at aggregate efficiency and overall productivity, you see a shift in the flow of resources towards IT, towards enterprise software, towards information systems, and away from, let's say, production or market-making exchanges. But you don't necessarily see that fee that's moving into the efficiency zone, IT and operations, moving into the consumer's benefit. And that's what I was conjuring this week. The obvious answer is both. Obviously, some of it's going to the consumer, some of it's going to him. But I'm interested in how you sort of look through the lens of the value capture between the innovator, Michael Bloomberg, Ken Griffin, whatever, and the marketplace when the innovation claims to be providing value to the consumer by adding liquidity, reducing spreads, et cetera, et cetera.
So there's a couple questions here. The overriding question is, let's talk about the role that efficiency plays in free market capitalism, because I think that's
what's the price of it. I would say, what's the price? Whether it's paying
let's talk about the price of efficiency in a true free market, because that's one of the beauties of an efficient market structure, or of a workable market structure. Efficiency is one of the beauties, and it's also the backbone of free markets and capitalism and everything else. And so I think that's.
But I want to clarify. I would say it's beyond that. It's the backbone of future-seeking capital risk and the stability of future. The willingness to originate business depends on it.
Sure. And so we can talk about the split and how that's figured out and how that works. And then the other side to it is, you can bring up, I think, even better examples at this point in time. One of which would be machine learning and artificial intelligence is the ultimate equalizer. So in other words, looking back over the last couple of decades, you needed a Ken Griffin, you needed a Michael Bloomberg, you needed whoever these innovators are.
Thinkorswim, I would argue Thinkorswim is in the same space.
I would argue too, and I would argue that so is Google and Amazon and everybody else. And what happens is, essentially, wherever there's a pseudo arbitrage opportunity because there's marketplace inefficiency because there's inefficiency in a true market, that now we're better with artificial intelligence and machine learning. We're in the greatest position ever to remove all those inefficiencies and to basically level the playing field for consumers, and almost everywhere where there's an inefficiency, we're able to level it. So, I mean, some of the examples that I would give you right now that you didn't mention that I think are, for example, in the insurance space, you're seeing that space is becoming, commoditized, and now there are, online insurance plans that give very minimal or marginal, premiums to the insurance broker. It's everything's. They've cut a lot of the edge out.
The decimalization writ large, right?
Essentially.
And spread crushing through technology and transparency.
I mean, you're starting to see it, in the pharmaceutical space with drugs. You're starting to see it lots of different places. It's going to happen everywhere because it's inevitable. It's unstoppable. It's a force. Efficiency is not something that anybody can control.
Let's move through this to the next point. Sure, I agree with you.
Okay,
and I love this, and I want to talk about this because what you just did with this, I absolutely love. I'm happy
because that's the real discussion here.
I know. So can we just cut to the chase? Can I just skip through the cut to this week?
Well, I was going to get to the payment for order flow thing because.
But no, forget it. Let's come back. I think you hit on a bigger idea. We have time. It's only a half hour. We'll do payment for order flow, but I think you hit on because it's interesting that you did that because again, this came to me because I was looking at global data and there's a data set called aggregate efficiency, which
Yeah.
basically looks at the unit of energy. The most obvious thing would be a barrel of oil, right? And then out of every barrel of oil, what percentage of that barrel of oil is actually used to create productive motion? And the most literal thing would be a car. And then you'd say for every gallon of gas, 80 cents of the dollar's worth of gas is used as dissipated heat. All these non-deployed energy releases, whatever that mechanism is, and only 5 to 10% of it is moving the tire over the road.
Right.
And they do that basic same math for global production. Trillions and trillions made, some abstraction. And they look at it and they look at the flow and the shift flow. And the question that jumped into the front of my mind when you gave your comment, which was compelling, is let's assume that I'm right-ish. It's a gray area for sure, but that a lot of the efficiency creators, whether it's Bloomberg or Griffin or anybody else, have been able to capture even 10% of the total spread collapse, or 5%, which is a massive piece of huge numbers. If the whole world is infected with process inefficiency, not because the process is inefficient, but because the price is wrong, because it's being overexploited by a single or a small group of technologists who own the rights to gatekeep that access to that efficiency. And it makes me wonder, and that's pervasive, pharmaceutical, financial, everywhere, oil, boat, rentals, never ends, everything, anything. If AI can actually provide similar efficiencies without the IP rights and provide the same payment for order flow, Mike Bloomberg's data set, pharmaceutical, whatever, all the gatekeeping and efficiency that makes up so much of the marketplace, and start to actually reduce the overall available pool of money for gatekeeping, whether it's a hedge fund manager down to a real estate lawyer,
Okay.
And so do you think that the AI can affect that? Do you think AI can drive down?
It depends. Do I think it can improve in that broad sense, certain markets? And the answer is no. In other marketplaces, the answer is absolutely, 1,000%. But I don't want to go off topic for a second, because there is an interesting, the discussion of how the consumer benefits from efficiency, is a really important piece to why I feel very differently about the future. Like, there was a couple of years ago when everybody from Elon to other people were saying, AI is essentially going to be the death of us. And the reason was they were scared of it because if you're in certain industries, you are there are reasons to be scared of efficiency without understanding what efficiency really does. But when you think about the growth, that's associated with efficiency, because what efficiency does is it allows the playing field, it levels the playing field, but at the same time, it introduces something into the equation that we've never had before as far as global growth goes, which is scale. See, you can have unlimited scale with marketplace efficiency. And so to use the stock market as an example, the reason for the explosive growth in the option world, they're up like 4,000% in the last 20 years growth wise, is because the markets are efficient. The reason for explosive growth on some of the consumer sides is because Amazon changed the way we buy goods.
Like air filters and pots and pans.
Everything. I mean, Costco changed the way we buy
relate
things.
To product.
Exactly. And it goes. There's actually it's limitless. It's boundless, I guess you should say. It's unstoppable. It's an unstoppable force into marketplaces that you can create, into a real marketplace. If you don't have a real marketplace,
all the one-sided gatekeeper.
Yeah, the one-sided stuff.
I call them the hide the pickle crowd.
Yeah. Like an example of something that hasn't been disrupted yet that I think is about to be disrupted is sports betting. And, the markets are still, let's call it, 10% wide. Their markets are basically 1,000 basis points wide, 500 to 1,000 basis points wide.
That's for your best possible bet on a liquid NFL game.
Whatever. Whatever. It doesn't matter what the game is.
But my point is it never gets tighter.
Right.
That's the tightest. And it might be worse, I'm assuming, if it's a weaker sport, a weaker game.
Right. So the technology has started to get more efficient. And eventually it's going to get to the point where we're going to go from 1,000 basis points down to 500 basis points, down to 100 basis points, down to 10 basis points. And does that mean that industry is going to go from 100 billion down to 2 billion? No, that industry is going to go from 100 billion to 200 billion.
I know, but my question, I agreed. But my question is, when that happens, for sure that's going to happen, right?
For sure.
But when that happens, the question is, Mike Bloomberg was like, first, there's no way they're going to be able to take phone calls every day to get bond prices. Eventually, the people in North Carolina and California are going to have a computer.
Of course.
They're going to check the price before they call New York. They're making fools of us out here.
Of course.
Same thing here, right? With sports betting.
Same thing here. Right? It's on everybody's. It's going to be
Griffin,
on your phone. Right. Yeah. Thanks to everybody.
Okay, agreed. No problem. But my question is, when that efficiency is implemented, we go from 1,000 to 10 over whatever period of time on the spread, 1,000 basis points to 10 basis points. What percentage of those 990 basis points is basically spread across better pot odds for all the betting pool because it's just sort of better price to the field? And what percentage of that spread is captured by the technology company, i.e. Bloomberg or payment for order flow, that everybody has to use to get those 10 basis point wide markets because it's where it's tight and it's fast and it moves and it fills and it flows and it flims and it's a river.
I mean, most of it goes to the consumer.
And why? And so how much?
Most 90%? Of it, like the majority of it goes to the consumer. Just think about it. Think about it.
99 or is that 60-40?
It's probably closer to 80-20, but just think about it this way. You used to have to go to the store, and before Amazon, you'd have to go to the store to buy a roll of toilet paper, just as an example. Buy a roll of toilet paper. And let's say that roll of toilet paper was, $1, just as an example. So you go to the store, you buy a roll of toilet paper for $1. Oh, along comes Amazon. Now you buy 2 rolls of toilet paper for $1.
And they ship it for free.
And everything else is the same. You don't even have to leave your house. You get it for free. But you get 2 rolls.
Crazy.
So what happened in the process? Did the consumer really benefit? And the answer is yes. The consumer absolutely benefited. They were paying $1. They were paying $1 for 1 roll. Now they're paying 50 cents. They're paying 50 cents a roll. So the consumer made out. But did Amazon, who is essentially
Bezos become the world's richest man? Yes, he did.
Yeah, and so they made out too. And then did the person who's actually did the firm that's actually making the toilet paper, did they make out? Because instead of selling 1 roll before, now it's selling 2 rolls. And before you say no, they're not really, yes, they are. So in the end, did their margin
create the price? No, because I'm going to tell you, I don't want to get into why the toilet paper man got screwed in that deal.
They didn't get screwed because that toilet paper company that was once worth $100 is now worth $200 or $300.
And all the jobs moved to China because of the price pressure.
That's not even true, remotely true.
Produced in Penang Island or someplace.
That's not even. That's
only way you can get into Costco. Only way you can get into Costco. But I don't want to get into this.
That is not true. That is an old school, like that's the idiot argument. I don't buy that for 1 second. That's
I don't
never
want to go down that. I got to go back. I got to stop the wheels. It's too much. It's very good. This is weeks of content. We should be we should be organized.
But this is why we've seen the stock market go from 666 to to 4.
Toilet paper man. More companies have access to the markets.
That's
toilet
right.
paper. Billions, way more than ever. Like incredible access for private companies. Stunning access. Crazy.
That's
right. Even global. Try it in London. Try it in Australia. They all know. Everybody does it. Something or other.
And technology is another example because technology the playing field has been leveled because you let Amazon sell 2 rolls of toilet paper for $1 instead of 1 roll for $1 from the old way. Because of that, the money that they made got reinvested to building technology infrastructure, and in this case, let's just call it the cloud, which allows people now to build more technology to go out and potentially disrupt Amazon with their own technology, but at the same time, they don't have to spend any money to build whatever they want to build, which 2 decades ago would have cost them. Basically, it would have been a barrier to entry. Now there's no barriers to entry. So now the level of competition is, it's crazy.
It's disruption of gatekeepers in every form is the ultimate technology best case, right? Whether it's spread, whether it's access to whatever the movie software is or whatever.
Yeah, whatever it is, it doesn't matter.
Access to professional tools, we'll say, and fair markets.
Whatever you want, exactly.
Liquidity and a place to sell. Fine. And I love it. But I don't know if it's true. And so here's my question for you. So let's go back to the efficiency transition and the capital capture. And let's say it's 80-20, 80 to the market, 20 to the technology pool, whether it's one person like Bezos or a few people like payment for order flow or a few people like Bloomberg and blah, blah. Alibaba is another one, I guess, in that whole thing. What if what's happening is really a vacuum cleaner run by technology that's sucking all of the money? It's using the story of adding all this value in your fabulous song and dance. But the reality mathematically is that it's actually removing access to resources in a really targeted way from the people that are actually the least able to adapt. Not even, let's say it's not malicious. Let's assume it's not, let's not assign prejudice. Okay. Let's say a coincidence of the system, which is naturally redistributing money to those who can exploit free access to tools and free access to fair markets, and taking it away from people who service in some sort of gatekeeping economy, whether it's a real estate broker, or whether it's a local corner toilet paper dealer, or whether it's a factory worker and wherever, never ends. And it's not that there's nothing wrong here. But the question is, if the technologist is taking too much money in the transition, which would be the same question you would ask of like Pfizer with the shot, like what's fair? You can't answer that question. I realize that. But it brings up a concern about monopoly, which is natural to efficiency gatekeeping, because the person who makes the most efficient market is the person who controls the order flow. Right? Order flow. Everybody thinks that they can win in the markets with the best tech. They're like, look at my screen. I have all these categories. I got all this access. I know all these rich people. You're like, you will never have a chance with your exchange, sir. And they're all like, why do you always reject every exchange? I'm like, the only exchange that stands a chance is one that is pre-existing participants, trust-bearing participants who create a ball of participation. Or a balance sheet to launch it. But even a balance sheet, you don't stand a chance because you don't have the trust. My point to you is, are we deluding ourselves with the story of efficiency when we're actually just being harvested by technology?
Oh, please. And my answer is, oh, please.
That was like your Grandma Jones answer. That's like, don't even come in my house with that.
Yeah. Don't even
knock on my door.
That's just.
But that's why we need to talk about.
That's a free shot. You can use that anytime. That's not even.
I agree. Generally, I would agree with you, but I'm saying at this moment when payment for, so I'm going to be very realpolitik. Okay. Payment for order flow's head is on the chopping block in Washington, D.C. today. Okay. Straight up.
Yeah.
Maybe it's not real. Maybe it's not really risk.
Sure, whatever.
But it's there. You never want your name on that list of even things that we talk about.
Sure.
And that at the SEC in the boardroom, blah, blah.
Sure.
Payment for order flow's best defense is your story, which is this creates an efficient market, which helps everybody. More toilet paper, 2 rules for 1, blah, blah, blah. Don't be mad at Jeff Bezos, i.e. payment the system, because the system is better than anything else that's ever come before, which is what you say, right? Not my, like, you want to try to, And so I'm saying the only way payment for order flow and its advocates, which I'm sort of on the fence with you, I'm in your direction to advocate it. I wouldn't go out so vehement as you. I don't feel like I know it as well as you do. You're a customer and a user.
Okay, sure.
I believe you and you're credible. And I'm
All right, whatever. Keep going.
If payment for order flow cannot articulate why in the F Ken Griffin has so much money. In other words, they don't ask about the reason they don't ask Mike Bloomberg. They don't ask because no one can understand the bond market. Okay. And even Jeff Bezos, they don't ask because they're like, well, that's what happens when you sell everybody in the world a toaster. Right? You become the world's richest man. But in Ken Griffin's case, they do understand because he's retail facing, unlike Mike Bloomberg, more like Jeff Bezos. Right? Because of Robinhood and behind Casey Trade and Schwab and all the payment for order flow, Citadel makes the markets, Ken has all this money. So it makes the question, which Mike Bloomberg evaded and a lot of other people, inevitable for him because he's a retail product. He's not a B2B product. Even if he wants to be B2B, he's outed as a B2C, as the liquidity provider for all these.
I'm listening.
So how does payment for order flow, what problem is payment for order flow solving? You've answered that. But how can you prove that this solution is in the benefit of the consumer and not just the industry?
Well, first of all, it does benefit the industry. It does benefit them, and it also benefits the consumer. And how can I prove that it benefits the consumer? Because the growth in the business is up by, like I said, 4,000%. And so, I mean, that is your proof. Businesses don't grow.
But the question is, but what's the price of a utility, going to last week's question? So maybe you get a lot of money for inventing the utility, but maybe then there's
I think the thing that's confusing people about, you're using a specific example like Ken Griffin and Citadel and things like that. And I think the thing that most people don't realize about this is that a lot of the money that they make is just in their hedge fund business, which is not their market making business.
Solve problems with optics. I
understand. Well, my point is the majority of the money that they made was on their performance of their hedge fund, not on their market making. The market making is a different part of their business.
The payment for order flow is not the headline of the hedge fund. Everybody else had a horrible year, and they made a 80 bajillion gajillion. That's not for payment for order flow.
Exactly, but on the payment for order flow side, there's if it was easy, there would be I think the easiest way to look at it, or the fairest way to look at it, is to say, hey, Deutsche Bank tried, but they dropped out. Goldman Sachs tried, but they dropped out. TD Bank tried, but they dropped out of this business. They all lost hundreds of millions, if not billions of dollars.
Trying to basically run money up front to kickstart liquidity and bypass.
They tried to do it. Morgan Stanley tries to do it today. Citigroup tries to do it. They weren't able to capture. Do you think we care where we route an order to? We don't. Our responsibility to our customers is to route the order for the best possible price, no matter what. We want the highest ratio of fills at the best possible prices. So we would route to anybody that makes the best market. The problem with all these other firms, the reason Goldman Sachs backed out, the reason Timber Hill backed out, which is Interactive Brokers, the reason TD Bank backed out, the reason Deutsche Bank backed out, the reason Citigroup can't get any business, the reason Susquehanna fell off, the reason Wolverine fell off, the reason that half these other firms aren't even in the business anymore is because they can't compete scale-wise or technology-wise. This is a technology game.
I would say also, though, it goes to my monopoly discussion, which is the inertia of a pool of liquidity is one of the most self-sustaining and difficult to move things in the world because everybody wants the best. Everybody always wants to feel.
Of course. But let me finish. So the opposite side of the example is so with Citadel, just as a perfect, because you use them. So it's a payment for order flow is a beautiful sharing system. The customer gets free technology and low commission rates. The brokerage firm gets to make some of the money back. It's like a rev share with the market makers. Okay, it all works beautifully. The other side of the example is and this is what the regulators don't get, and this is why Gary Gensler's so bad for, the free markets that we have, is the exchanges are really who's at fault. The traditional exchanges, because they're public companies, they're the ones that created this opportunity because of their marketplace inefficiency.
Because they had inefficient market driven by short-term greed.
Exactly. So high exchange fees, high cost of data and everything else, virtually impossible to negotiate with on any level. They would have no responsibility for any of the fills or anything else. So firms like us, we can't write to the exchanges. They're incompetent. They're flat out incompetent. They don't take responsibility for their errors. They don't offer you the best marketplace. They overcharge you for everything, and they audit you and fill you. And they audit you.
It's the ultimate in a gatekeeper monopoly.
All because they're publicly traded and they're not truly
high fees, low service.
Exactly. And so along comes somebody who says, "Hey, you know what? I'm just going to build better technology, and I'm going to build, an off-floor exchange essentially, and I'm going to share with you." And I'm going to share with the consumer. And I'm going to give you way better markets on everything. Because if you don't make the best market, you don't get the order. It's that simple. I mean, just because some XYZ company is a high-frequency company, if they don't make the best market, remember, all the orders get actually filled on an exchange.
But you can see where in a boardroom now, if I'm the head of the SEC, okay, that all sounds great coming out of Chicago or New York. But I'm in Washington, D.C.
Yeah, but you got to understand, every order gets filled on an exchange. So if somebody wants to participate with that order,
sounds to me like you're sabotaging our exchanges.
All you got to do is make a better market, but they can't because they're so damn inefficient and they're so bad at what they do that they can't.
Maybe you've got there's something going on here.
No, there's nothing going on. If you want the order, just make a better market. And the reason you don't get the orders is because you don't make a better market.
Tell me the New York Stock Exchange doesn't make good markets.
They don't make a better market. They don't make good enough markets.
Make a better market.
No, in other words, if I go in to sell, let's just say I go in to sell 100 shares at $100, okay? Then it's just first come, first serve. Nobody gets that order. But in order for somebody to participate with that order, they got to pay $100.01 because then they get the order. So what the firms like Citadel will do and other firms like that is they'll pay 102 because they want the whole order. And the New York Stock Exchange says, "Hey,
it's like making markets in the keyword Paris if you're Expedia."
So they pay $1.02.
They pay the best price for the order.
So they get the whole order. And then who benefits from that? The customer. And not only do they pay $1.02, so the customer gets 2 cents better. They also pay the brokerage firm a couple of pennies, or a fraction of a penny. So the brokerage firm makes a little money on the trade. And so the customer wins, the brokerage firm wins, and who gets cut out? The exchange. Who cares?
Yeah, but at the same time, how do I know that you're giving the customer the best service when you are beholden to a private company that's not a regulated government?
You're not beholden because
you are beholden economically, even if you're not contractually, because he always has the best price, or she or they.
Because it's not one firm; it's dozens.
I get it, but so let's say the private payment for order flow market,
yeah,
not a person,
yeah, sure,
versus the exchange,
because it always the order still has to get filled on the exchange.
To the private sector,
there's no loyalty. The order has to get filled on the exchange. So if they weren't there, the order would just fill on the exchange at their price. Their price is always worse. It's simple, Dylan.
My point. I'm just a simple regulator from Iowa.
Yeah.
Okay. And all I know is you wouldn't be paying them if it wasn't worth something.
Can I explain why it's worth something then? Maybe here, let me do this.
Guy is paying the brokers for something.
I understand. Let me explain.
I did just walk off the farm yesterday.
I know, but you actually did. Let me explain why. Because, and now I need everybody to grasp this because this is the most fascinating part to it. So, if you're Dylan Radigan, specialist on the floor of the New York Stock Exchange, okay, and you're working for yourself or for Joe Blow firm, whatever it is, and you're standing there, okay, and you're standing in the IBM crowd, you're a specialist in the IBM crowd, and you're on electronic system, but I'm just going to talk old school for a second, and you're $100 bid for your stock. That's your bid, okay? If you had to pay over $100 for that, it wouldn't make a lot of sense. There's no theoretical edge for you. So you sit there at $100 because you're Dylan Radigan.
And there's no liquidity above 100 because there's
That's
no
right.
reason to make liquidity 101.
That's right. Because all you do is trade IBM. And you are the IBM master. And so you're $100 bid, you're at 110, and that's your market, and you have the biggest position in the world at IBM, and you are the main market maker. But you're only going to pay $1 or sell it at $1.10. Along comes this other firm that doesn't care what they're trading. They could be trading IBM or any other tech stock, any one of another 150 tech stocks. They don't even look at the name on the stock. And all they care about is theoretical equivalency to some beta-weighted theoretical equivalency to an overall position that has hundreds of millions of positions in it. So all they care about in this case is if they need to buy stock, where you're Dylan Radigan, you can only pay $100 to that stock. They can pay $100.05 because it's still better than paying $100.10 where they would have to pay if they went into the open marketplace. So because they have changed the game by managing portfolios differently, they have a different set of theoretical values than you do. So nobody loses, okay, except the old school specialist, which is why I left the floor when I did, because I saw this coming. The old school specialists can't compete because they're not managing a portfolio, they're managing an individual stock. So where you were just thinking like a regulator, and this is the problem we have with idiot regulators, is they're thinking like, oh man, this one person here, he just got his market carped because somebody paid a nickel higher, and why would they pay it if it wasn't worth that? Or why would they pay it if they couldn't make money off it?
And you're saying it's because they're running a totally different math equation, which is based on instead of running the math equation of a single balance sheet manager, they're running the math equation of a portfolio manager, which totally changes their.
They're in a completely different business. It's not even the same business. So that's why you can't compare. That's why people don't get this. That's why the Wall Street Journal F's this up every time they talk about it. That's why all these other people and other networks mess this up when they talk about it, because they don't understand. They're playing different games.
I'm going to tell you this, though. I'm going full.
I'm going to need therapy after today.
I'm going Georgia prosecutor. I'm going Mississippi prosecutor.
Oh, God.
There's just no way, sir. You pay for something, but you didn't expect nothing.
I agree. Who's saying they didn't expect anything?
But the point is that what they expect when they pay is that the models on the portfolio risk are correct in justifying the higher price that a balance sheet manager wouldn't pay.
It's a scale business versus it's a traditional fundamental business versus a scale business. And the scale business is a technology business based around efficiency. And that's all it is. It's a different business.
I got 2 minutes left in my interrogation at this point. If I am responsible for any material percentage of the order flow through a payment for order flow system, i.e. whatever, any private for payment order. And at the same time, I'm managing a custodial risk portfolio of investment of millions and thousands of positions at the same time. Doesn't it make sense that I would acquire intelligence about market pricing from my payment for order flow system by giving myself surveillance to see order flow and trade in front of that in my hedge fund?
No, it doesn't even happen. It's not even possible.
Why not? Seriously, why not?
Seriously, why not?
You're saying because it happens with that the speed at which the order flow fills, that even if you're in the room, you couldn't get in front of it.
Here, we're talking about milliseconds, and we're talking about you have to remember the world's. This is not everything's changed. Everybody's indifferent. Nobody cares what anybody trades anymore. There is no way to jump in front of anything. Like it's not there. There is no traditional order flow the way it used to be. There is no
That's
jumping.
not what they think in DC, sir.
Obviously because nobody gets the business has moved at a pace. DC is living in 1983 still. And the rules and regulations are still from the 80s. But we're trading on technology now that is 40 years past the rules and regulations. And so they're not clear of the concept. That's all there is to it. They're simply not clear of the concept.
So maybe then it's time to not be angry with them and accept they just don't understand and they need to be educated before they act further.
It's incredibly difficult message. That message is as difficult as, and we're challenged with that all the time because nobody's willing to make those changes because we have a messed up political system.
I think Gary Gensler would take a meeting with you.
Gary Gensler wouldn't even, he wouldn't play Wordle with me. Trust me. There would be.
He would take a meeting.
No.
You are a titan of the industry, sir.
We have tried so hard, Dylan. We have tried so hard. We basically, you can only spend so much of your resources and so much of your life trying to, people have a lot of motives. Like Gary has plenty of either political, a political agenda, a different agenda. I don't really know. I don't really care. But it's obvious from what they're trying to do that their agenda is not trying to further the business.
Is adversarial to what's good for the industry.
That's right. They're not trying to help.
But you're interpreting that adversarial posture as deliberate or as ignorant, or I'm suggesting maybe it's just ignorance, maybe it's not malice.
It's not malice. It's ignorance, and it's just a different agenda. Everything in the world now is about optics, and everybody wants to present the right optics. What looks good. And that's all it is, It's just
a signal. It's not an actual. There's no cool.
And their time is short lived. You can't make changes, and that's why nobody changes the tax code. That's why nobody does lots of stuff in Washington, because everybody thinks I can't get this done in 2 years or 3 years or 4 years. So listen,
that's a different thing.
Yeah,
the point is that you believe that the efficiency is moving and that efficiency is real. And I'm imagining a room with like 10 computers with names that are all AI identities, like Bob and Eric and Sam and Sally. And then you just appoint them as subject matter experts and ask them questions and force them to learn. All of a sudden you have your own team of rocket scientists just with 10 laptops and AI. It's a way you'd act like if AI is as good as we would hope, which is obviously not yet. In theory, you could manage AI as you would any subject matter expert, and then use that for information gathering, and then have humans to decide non-data based decisions, shall we say, that are more visceral.
I want to end this on just a quick little recap about the part that interests me the most discussion-wise, which is about efficiency. And I think that you started off the conversation today talking about efficiency and what impact I think efficiency has on the consumer and on the future.
And those who invent the efficiency, the split between the inventor of the efficiency and the market.
I believe that efficiency, this is the first time in my entire life that I can remember marketplace efficiency playing the role that it plays today, and how exciting that is about future valuations, because that is, when you look at the companies that have exploded over the last 2 decades, they all have mastered a certain specific area of marketplace efficiency, and I think that trend is not reversible. And I think that that's something that you should look for in the future. Companies that if you find a company and you believe that they've done something that changes the efficiency in a certain space, you roll with them, because that is the future.
If there's anybody watching at home who's ever seen the Dustin Hoffman film The Graduate, there's a scene at the swimming pool at the beginning where an old man takes a young lad aside and tells him that plastics is going to be the most explosive marketplace in the economy for some time to come. Well, note here on January 25th, 2023, that Uncle Tom Sosnoff
Oh boy.
has declared if anybody approaches you with an opportunity in market efficiency, young lady, you give it a good hard look. That might be good for you.
That's the first graduate reference. That's the first graduate reference I've heard in 30 years. I think since my mom mentioned, 40 years.
Critical social metaphor for all humans. If you haven't seen it, I highly recommend it. But that probably, is my opinion. But it's a bit generational, perhaps.
I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Dylan, thank you so much.
Be efficient out there. I'm going to be an old man with 10 laptops. You'll see it, with asking them questions with a plan. See you later.
See you later.